Welcome back, everyone. This week, we're going to do something a little bit different. For those who don't know, I have a Substack and I write on it. And this week, we're going to cover one of the things I have written on Kilroy. And we're going to go through that, and I'm going to read it to you, and you can look at the pictures. And I'm going to put a link in the description if you want to go visit the site and see what else I've written about. And I write from time to time. I don't update regularly. And honestly, I didn't want to make a video after working on this. So I've made this into a video. I'll try to minimize this, but I've thought about it for a while, and I'll probably integrate some of the articles I've written into this channel for you all to watch and listen to if you're not interested in reading. So with that out of the way, at the end, I've included my stock performance for the week of my portfolio. We'll cover that, and we'll just kind of blend this all together like I normally do. And with that out of the way, let's get into this. Office age. Kilroy is a leading space provider in portfolio age and quality. Age matters. Why? On the lessee side, it's more desirable due to modernized amenities, and on the lessor side, it is beneficial due to less maintenance capex. Also, I'd like to note, the reason you're seeing this not in the Substack form is because I do not know how to transfer over highlighted text to Substack. But when I transfer this over to Substack, the highlights disappear. And until I can figure that out, that's why you'll notice this isn't on Substack. So please keep that in mind and be understanding. Occupancy. Did you know that their occupancy has been falling since 2015? I'll save you all the pictures denoting the drop, but you're more than welcome to put in the work yourself if you don't believe me. In 2015, the year-to-date average occupancy was 95.6%. Every year since then, their numbers have been dropping to the current state, 88.6%. Why should I think now is when occupancy will stop deteriorating? It seems there's more going on here than the work from home catalyst. Is there a structural and regional phenomenon at play? Most people will cite San Francisco as being a garbage heap and everyone is fleeing. But look at their San Francisco numbers. You'll see that their total San Francisco Bay Area is 92.3% occupied as of June 30th, 2023, and 93.8% leased. Their San Francisco office occupancy is comparable to many of the Sunbelt regions. The below is from Cousins Properties Q2 2023 supplemental information. And here you'll see certain places with certain percentages. We'll get into that in a moment. So it's always worthwhile to compare and contrast by putting things into context. Why? Because it forces you to ask tough questions. Tough questions that the prevailing narrative would make you think isn't true. Just as people lump the West Coast all together, they also lump the Sun Belt all together. And that's foolish, to say the least. Let's look at Atlanta, Dallas, and Houston. So now let's compare these. LA equals 81.5% occupancy. Seattle is at 83.4% occupancy. San Diego is at 85.4% occupancy. Versus Houston being at 79.8% occupancy, Atlanta being at 83.5% occupancy, and Phoenix at 85.7% occupancy. Not in a million years would I have thought that those locations were comparable in occupancy. Of course, this is a static picture of Q2 2023 numbers, which means it doesn't factor in any other variables such as rate of change of their respective submarkets. But still, I'm shocked to see the similarities. I knew that Houston and Atlanta were overbuilding relative to current demand, but I didn't realize it was this dire. The argument here is that those vacancies will get filled due to the continual trend south, and that will continue to put pressure on the West Coast offices. But can't they share? Leasing activity. Between new and renewal leases, they've managed to execute on 5,500,000 square feet this year. 550,000 square feet this year. At the end of Q2 2022, they managed to lease 406,000 square feet. So it's an improvement on leasing, but not so fast. The weighted average lease term dropped from 92 months in Q2 2022 to 62 months Q2 2023. You'll also see the TILC per square foot, which is tenant improvements and leasing commissions, went from $11.57 to $11.97. That's an extra $220,000 worth, to put it in perspective. I think that the increase is a consequence of shorter lease terms. At least that makes sense to me. I don't know how to pair it with this though. If any of you know, put it in the comments section. The recurring tenant improvements, leasing commissions, and capital expenditures is up 3,500 from this time last year. Q2 2022 was 32,178 and Q2 2023 was 35,616. This is a problem of having more questions than answers. Either way, leasing activity seems to be doing well enough. Then I show this is the executive summary of Q2 2023. Now compare it to last quarter, Q1 2023. The stabilized portfolio fell 3%, with both GAAP and cash rents increasing quarter over quarter. But don't let that fool you. There's a difference between rate of change and absolute numbers. Changes in cash rents are still negative year to date, but headed in the right direction. Funds from operation, net operating income. I'll quote them here. The company is providing an updated guidance range of NAREIT defined FFO per diluted share for its fiscal year 2023 of $4.43 to $4.53 per share, with a midpoint of $4.48 per share. This is an improvement over last quarter's guidance, which was them guiding for a midpoint of $4.40 per share, to sum it up. Management in Q2 raised midpoint guidance from $4.40 to $4.48, an 8-cent difference. Whoopee. But whoopee indeed. To go from $4.40 to $4.48 is a 1.81% improvement. But it's not just a 1.81% result. Let's discuss why. KRC is currently trading at an 8 times price to funds from operation, roughly speaking. As of me writing this section, it's trading at $35. And the emphasis of this is sometimes these things take weeks to compile. So when I was writing this section, literally, it was $35. I think right now, reading this, it's $33. Anyway, just please understand that. As of me writing this section, it's trading at $35. This means that if we recognize the $4.48 midpoint upgrade to guidance and slap an 8 times multiple on it, then the stock is fairly valued at $35.84. So for all intents and purposes, we can say it's fairly valued as of today, which would have been September 18th, 2023. However, if things are improving, which on a quarter over quarter basis you could argue they are, then what if we get an 8 or 10 times multiple? I want to see what the difference would be in regards to that extra 8-cent increase in guidance. Small numbers make big differences. $4.40 FFO with a 9 times multiple means that the stock trades at $39.60. At a 10 times multiple, it would trade at $44. Now, with the midpoint adjustment going up by 8 cents, If you use a 9 times multiple, it trades at $40.32, and at a 10 times multiple, it would trade at $44.80. Let's put this in context. If you invested $1,000 in a KRC at $35 a share and it got re-rated from an 8 times multiple to a 9 times multiple, but guided for the $4.40 funds from operation, you would make roughly 13.14%, or $131.40. That would be, yeah, okay. However, if you re-rated the stock from its current 8 times multiple to a 9 times multiple, but guided towards the newly revised $4.48, you would make 15.2%, or $152, which is to say that an 8-cent difference manages to make a $20.60 difference to your account. If you invested $10,000 in KRC instead, a so-called piddly 8-cent midpoint adjustment in guidance would make a $206 difference in your account balance. Now keep in mind, this works just as much, if not more, in reverse. Multiple expansions and contractions are a big part of this game. Sentiment or fundamentals towards office isn't there yet to create much of an expansionary regime, so we'll have to keep this in mind. Here's something else that's crazy: percentage gains. What started out as a small difference adds up. $4.40 to $4.48 matters, especially when you're trading up to fair value. Fair value at an 8 times multiple at the Q1 guidance of $4.40 would make the stock a $35.20 stock. But using an 8 times multiple with the new revised higher guidance of $4.48 equals $35.84. To go from today's trading price of $35 at an 8 times forward FFO to close the discount gap would amount to a 0.57% increase to fair value using Q1 guidance and a 2.4% increase using Q2 guidance. A net difference of 1.83%. Now, if you're paying attention, you'll notice a 0.02% difference, and that's a clue to something important. And that 0.02% difference, I just wrote here, a net difference of 1.83, but initially, to go from $4.40 to $4.48 is a 1.81 difference. So what's happening? Let's try an 8 times multiple. $35 current stock price guiding at $4.40 per share at a 9 times multiple would price fair value at $39.60 per share, a 13.14% increase. $35 current stock price guided at a revised $4.48 per share at a 9 times multiple would price fair value at $40.32 per share, a 15.2% increase. That's now a net difference of 2.06. So what started off as a measly 1.81% difference magnifies the higher of a multiple the stock trades at. What this is demonstrating is that a slight rise in guidance in conjunction with earnings multiple re-ratings can add a lot of torque to the returns, more than most people ever consider. If I didn't know any better, I wouldn't believe it myself. And I digress here for a moment. Along these lines, think of a company that makes a product which costs $1 to make. It sells that product for $1.10. The company has a 10% profit margin. Now just imagine if material or labor inflation rose by a piddly 5 cents. It now costs $1.05 to make it, and they sell it for $1.10. Guess what just happened? They cut their profits in half, all because of a piddly 5% cost inflation, all because of an additional 5% cost of manufacturing. Which is to say, that a 10% increase of production would wipe out their entire profit. So when you hear of a company having cost inflation issues, don't say to yourself, but overall it's a small percentage of the overall cost of production, so they'll be fine. Because the fact is that they won't necessarily be fine, because their margins were also a small percentage of the overall product. Before I'm done belaboring this point to emphasize its significance, let's look at one last quick example. At its peak, KRC was trading for roughly 16 times funds from operation. I don't think we'll see that sort of multiple anytime soon, if ever, but let's see what the numbers look like to bring this point of mine home. After all, you're buying because you think the industry is going to inflect. And with inflections comes multiple expansions. And yes, I know, for it to reach a 16 times multiple, the funds from operation in all reality would have to increase. But what I'm trying to do is control for independent variables to keep things simple enough. At the current $35 stock price, guiding at $4.40 per share at a 16 times multiple, would price fair value at $70.40, a 101.14% increase. At the current $35 stock price, guiding at the higher revised $4.48 per share at a 16 times multiple, would price fair value at $71.68 per share, a 104.8% increase. That's now a net difference of 3.66%. But remember that 1,000 initial investment into KRC? A simple 8-cent guidance change has quite the domino effect. At $4.40 guidance, your portfolio account balance would be $2,011.40. At the revised $4.48 guidance, your account balance would be $2,048. That's a $36.60 difference, which is to say a whole other share of stock at the current market price that you got for free. That's an interesting way of looking at it. One last digression. I think about the people who bought RIG, Transocean, at 70 cents. It's now currently trading at $8.30. RIG is a volatile stock, and it isn't unheard of for it to move multiple percentage points a day, which is to say that an 8.4% or 70-cent swing in price is the entire price that that person originally paid. Thinking this way helps put things into perspective. Here they were once upon a time watching it go from 70 cents to 76 cents, and they were exhilarated. Now that same 8.4% movement, may I remind you, the same 8.4% movement, may I remind you. Now on any given day now, the stock might swing up or down what their initial cost basis once was, or still is. So back to the topic. Funds from operation improved year over year too. Year to date, 2023, FFO is sitting at $287,812. Now remember, these numbers are all in thousands, so it's $287,812,000. So probably should have made that disclaimer beforehand. Too late now. Now compare this to year-to-date 2022 FFO, which was $277,119. So that's a rough, let's just do the math, a rough $10,000 difference. So yeah, but it's not $10,000. It's $10 million. So that's a $10 million difference of FFO. On to interest expense and debt. What's important is how much interest is going to cut into funds from operation. Management is projecting a range of $528,000 to $540,300 for FFO. That's their full year 2023 forecast range. Interest expense is up 27.75%, going from $40,746 to $52,054 year over year. With an S&P BBB credit rating, it could be worse. They have $431,006 coming due in 2024. Now, as I pointed out in the HPP article, I can't help but think about Piedmont Office Realty Trust, both because HPP and PDM, Piedmont, have had roughly the same amount of debt coming due in 2024, but also to use Piedmont recent movements in the credit market to act as an indicator to what might occur with HPP. Piedmont has $400,000 coming due in 2024. The way they went about resolving that was by issuing a 5-year unsecured note bearing interest at 9.25% interest rate. That's an increase of 5% over the prior loan. Ouch. Will HPP do something similar? Keep in mind that the additional 5% is going to incur them roughly $20 million more in interest expense per year. Why does that matter? Being that KRC and Piedmont both have Moody's credit rating of a Baa2, it isn't unreasonable at this point to think that KRC might do something similar. If that is the case, then they too will have a $20 million hit roughly to the funds from operation. All else being equal, if KRC does the same funds from operation next year as they project to do this year, then that would hit their funds from operation per share. But how much? How much would that additional $20 million a year, roughly, in interest expense cut into their funds from operation? How much would it reduce it? That's the question. Well, at 119,200 shares, at $528,000 funds from operation equals $4.43 per share. With a current 8 times multiple, that puts the shares at $35.44. At today's price of $35 per share, that's up 1.26%. If KRC has to refinance in a similar fashion to what Piedmont did, then that's going to be an extra $21,550 taken out of their FFO. So let's do the math again. 119,200 shares at $506,450 for funds from operation equals $4.25 per share. With a current 8 times multiplier, that puts the shares at $33.99. At today's price of $35 per share, that's down 2.89%. All else being equal, this is to say that your risk-reward asymmetry is skewed towards the downside. Buying at $35 comes at the risk of a 2-to-1 loss to reward. Your upside is 1.26%, and your downside is more than twice that, 2.89%. This is all to say that they need to grow their funds from operation, cut back on TILC, have interest rates go down, or something. It's currently fairly valued on a price of funds from operation standpoint if you agree that an 8 times multiple is reasonable, which is definitely up for debate. The reason for that multiple is due to the grim recent past and how it's being extrapolated into the future. If your base case is a stabilization or stagnation of funds from operation, an occupancy and a halt to the deterioration caused by vacancies and interest expense for the year 2024, then the stock is priced reasonably for this. You can't say that it's historically cheap over the past decade, although it is. Why? because occupancies and interest expense is no longer currently where it's been for the last decade. You have to keep constant your comparisons and control for the variables. This is all to say that you'll need to take a longer dated view on the return to office theme, and a 6% yielding dividend can help with that. Covenants. Here we have Q2 2023 covenants and their compliance. And then here you have your Q2 2022 covenants. What do we notice? They eked out a couple of improvements. For those listening, still, they eked out a slight improvement on their fixed charge coverage ratio, and they eked out a slight improvement on their unencumbered asset pool debt service coverage. Don't let that draw your attention away from the multiple segments deteriorating. But hey, it's not as terrible as others. And that statement itself should let you know what kind of sentiment is being priced into these names if an 8 times price to funds from operation wasn't a large enough hint. Tenant concentration and tech layoffs. This is, by the way, my favorite section. Can't say why, but it kind of actually blew my mind in this nuanced, one-off, single example of how things are going. So let's get into it instead of me just making stuff up. It was just last year in 2022 that the tech layoff onslaught took place. And ever since then, a majority of people have been citing that as to why the West Coast real estate office market is going to collapse, but not so fast. First of all, it'll be interest rates that ruin them quicker than a trickle back to office would. Visual Capitalist, fantastic site as far as I'm concerned, does a great job again with this chart. I'm sure we've all seen charts like this from floating around last year. It just so happens that a few of these companies are tenants of KRC. God's honest truth. I'm randomly selecting Salesforce because they all seem like office type jobs. I was going to pick Amazon, but who knows how many are warehouse workers versus office workers. Salesforce is still the 7th largest tenant of KRC. I must say that my random selection turned out much better than I thought it would. Is it selection bias? Is this a representative sample size, and is Salesforce an outlier? That's all quite possible. However, with those caveats out of the way, let's look into these numbers. And by the way, I'm dead serious. I don't know if this is a one-off with Salesforce and things, and it's not representative of the aggregate sample size. I haven't explored much deeper, so I'm kind of treating it as though it might be a statistical outlier, but I honestly don't know. According to Salesforce 2021 10K, as of January 31st, 2021, we had 56,606 employees. And again, Salesforce 2022 10K, they had 73,541 employees. And then their 2023 10K, as of January 31st, 2023, they had 79,390 employees. All right, but let's not forget that they laid some human capital off. How many? Most recently, and to my surprise, on January 4th, 2023, they laid off roughly 8,000 people. This employee letter explains that. Seemingly, the reason is that they hired quote unquote, hired too many people. And that they, here it says, blah, blah, blah. However, the environment remains challenging and our customers are taking a more measured approach to their purchasing decisions. With this in mind, we've made the very difficult decision to reduce our workforce by about 10%, mostly over the coming weeks. But what about the layoffs in November of 2022? According to Salesforce BIN, they laid off roughly 1,000 people. Between the 1,000 people that got laid off in November of 2022 and the 7,939 people at the beginning of January 2023, that brings our total to 8,939 friends and family members succumbing to their workforce reduction. As a side note, with the current meme floating around about how men always think about the Roman Empire, I came to become a statistic myself. Once I read that Salesforce reduced their workforce by 10%, I thought to myself, didn't the Romans do something similar? If you don't know and are interested, it's called decimation as a form of punishment. Anyway, back to business. 8,939 people got fired, which brings their human capital back to where it probably was late 2022. Whoop-de-doo. That's not nearly as bad as what the sensationalist headlines would have you to come and believe. And in recent headlines, which I, God's honest truth, stumbled across when trying to figure out how many people they fired, I discovered that they're apparently hiring some of them back. Roughly 3,300 of them. My point here is that you can't just believe the agitprop being funneled into your eyes. Yes, tech companies laid people off in 2022, but back to what levels? This is why context is so important. So, was 2022 a tech Armageddon, or them trimming back a small percentage of employee bloat because the companies got a little too eager and relaxed with hiring? Just imagine two titles. One says, Tech companies laying off by the thousands, versus a headline that says, tech companies are higher than they were pre-pandemic. They're both facts, but their key difference is their unidimensional style of presentation. I'll leave you with a quote to emphasize this point. It applies to headlines too. Statistics are like bikinis. What they reveal is suggestive, but what they conceal is vital. We're getting to the end. Hold in there. CEO retires. John Kilroy is retiring, as explained in this letter. He's a 73-year-old man who's been a long-standing CEO. So no, this isn't a get-off-the-boat-before-it-sinks conspiracy in regards to REITs. Only time will tell if his successor is a good fit. Do they have a bathwater quarter after the new CEO comes in? Meaning, does he get a shot to blame everything on old management, tank the stock in the process, because that's their one opportunity to do something radical as a new CEO? And the reason that's a relevant question is because it's a common enough tactic, strategy, and phenomenon in the markets. So we have to keep our eyes open. Concerns. My predominant concern with all REITs is it appears that Treasury yields are getting ready to break out, not necessarily work from home. Addendum. I wrote the above sentence a few days ago, and since then, they have indeed broken out. Is it a bear trap or something more substantial setting up? That is the question. And no, I don't have an answer. Disclosure. We're at the end. I'm a current bag holder of KRC. I initiated a position in the past couple of weeks. And actually, if you stay tuned for a moment, if you're actually watching this whole thing for the KRC, I'm actually down, I am down 12.68%. And it's 4.97% of my portfolio. So there you go. With out of the way, I'm done with that segment. If you're unfamiliar, haven't watched this video before, just watched it for the KRC. On my channel, I do a weekly portfolio review of the names I'm holding, thoughts, so on and so forth. So you can stick around for that. And if not, then we're done in regards to KRC. Okay. So there's a few things I want to note. Treasuries broke out on Thursday. I did not put a chart in here, sorry. In the process of doing that, pretty much my REIT names, I would just say in aggregate, they fell 6%. And normally, I have a stop loss, if you will, in trade names at 10%. So at that point, it was triggered. And then the question is do I sell them, cut my losses, buy back later, or what? So what I did was I bought TMV. Now, I don't like doing this, and so far it's not working for me. So TMV is a 3 times inverse 20-year Treasury ETF. Why did I buy it? Well, theoretically, I'm hedged. If the Treasuries fall 2%, REITs fall 6%, which means that either I can have 3 times of a large position to be fully hedged on my REITs, or I can buy the same proportional amount that's 3 times leveraged. That's what I did. Now, the only reason I did this, I do not like doing this. You will see this very few times in the coming years in my behavior. I very rarely ever hedge. Why? Friday's a perfect example. It's one day, I know, but perfect example. What happened Friday? Bonds went up, yields went down, so therefore my TMV, that's the ticker symbol of the inverse ETF, it fell. Okay? So you would think, oh, the REITs going up would offset that, but that's not what happened. The REITs also went down. That's why I don't like it, because you end up losing money on both sides. I mean, it's bad enough to lose money on one side, so then you go and lose money on both sides. So the only reason I put it on is September 1st, I was going to short Treasuries because I thought yields were going to go up. Or the chart was setting up very nicely for it. Number one, I don't want to believe, and still kind of don't, that yields are going to go up. From a citizen, from an economic standpoint, from all of it, I really don't want yields to go up. And I'm like, no way, like this can't be happening. So, and they it all looked oversold and everything. I'm like, this can't happen. And then it broke out. Now, like I say, is it a bear trap? Does it all reverse and elongated yields go back down to 4%? Possibly. But such a nice looking chart setup. But I didn't want to just short it. I didn't want to implement a tactical trade to the short side on top of that. So I just left it alone. So I did not put the trade on September 1st. In hindsight, now I've put it on because my justification is using it as a hedge. Plus, it's still an interesting setup. And I kind of mulled it over in my brain. Do I wait for the breakout, which is not my style? And there's a reason why people wait for breakouts, because sometimes things don't break out. So you want confirmation before you get in the trade. I understand it. It's a reasonable enough explanation, especially on a trade. It's not like if you fundamentally believed in something, then you just buy it, and if it doesn't break out, then you accumulate more until it does break out, if you really do think it's going to break out. So that's why I didn't put the trade on September 1st. I didn't want to put a tactical trade on shorting treasuries and something that I didn't want to happen but thought could happen, and so I just left it alone. There's better ways to make money going along good names and good themes. So the only reason I have this hedge, if you wish to call it that, is because I was already eyeballing it as a tactical trade. And so far it's not working for me. So see what happens. I would like to say I might change this, but you might ask, when will I take it off? And I would say either when treasuries hit a 4% yield or a 5% yield. Right now we're roughly 4.5%. So see what happens. Now with that said, REITs really did not do well this last week. Actually, ever since I bought these, I actually bought them when, if it was a tactical trade, I would have sold them. It was kind of stupid on my behalf. And well, because it kind of looked like they were breaking out of these patterns, and then they did not. So as I just said a couple minutes ago about why people wait for breakouts, this is why. So that way they're not down 12.68%, down 7.67%, and down 12.13%. That's why they wait for the breakout. Or have a good stop loss, which I did not stop loss it. So here we are. And even with my rates tanking this week, my portfolio is down for the week 1.5%, roughly. Now, you might say, how is that possible? My names have fallen like 8-10% in a week, something like that. 6 to 10%, something like that. How is it possible that I'm only down 1.5%? And the answer is because 50% of my portfolio is in offshore oil and uranium. I maxed out on my position. As I've said and will continue to say, I have a 33% max for a theme. Offshore oil is a theme. And I have 33% between Tidewater, Transocean, and Valaris. I have 33% exposure. I can't have any more exposure. And by the way, this is leading and justifying what's so far been the office REIT mishap. So then comes uranium. Well, as those who watch this video or this channel know, I recently transferred from TD Ameritrade to Fidelity. On TD Ameritrade, you couldn't buy Sprout Uranium Trust. On Fidelity, you can. Technically, you could on TD Ameritrade, but you had to call it in. And I'm not going to bother doing that. So I didn't. So ever since I transferred to Fidelity, I've wanted to buy the Sprout Physical Uranium Trust, but pretty much the same time I transferred over is when uranium broke out, and I don't like chasing things. I don't do well with that. So I haven't bought it, and it's just gone up since. And that means I'm currently limited to 20% exposure because URNM can only be 20% because 20% to any single name, which means I can add 13% of my portfolio to the Sprout Physical Uranium Trust. But I'm not a big person on buying breakouts. So here I am. Why am I saying all of this? Well, between uranium and offshore oil, that's 50% of my portfolio. 10% of my portfolio is cash. So then you have to ask the question, what am I going to do with the other 40% of my portfolio? Seriously. Because if I just had the uranium and offshore exposure, I'd be at 50% cash right now. So, then what? I would underperform. Now, the funny thing is all the stuff that I'm down on, this is the hilarious part. I'd actually be doing better right now sitting in cash than having all these names tank my performance, because I'd at least be yielding 5%. So far, it's not working out well. I can't say like I said, I think the work from home thing is only going to revert more and more to people going back to the office. The whole problem with the office REIT segment is twofold. The first one's interest rate, and that completely destroys the buying the stocks aspect of it. And then, people still might return to work and the occupancies might go up, but with higher interest rates, the stocks aren't going to do well. So I could get the work from home reverting back to the office, get that thesis correct, and still fail in my investment due to the interest rate component. And so far, that's what's happening. And that's therefore why I made it 10% of my portfolio roughly, because I can't size it up. Not with interest rates doing what they're doing. I just can't meaningfully size it up as trade. And that's why, even though they tanked, it's a fraction of my portfolio, so therefore I did well enough. And that's why I actually beat the S&P on the week. The S&P's down more than 1.5%. I actually managed to, I I still lost 1.5% this week, but I actually lost less than the S&P. So that's that. That's why it's so crucial to position size. And when you have more conviction on something, to position size in that. So back to the question I asked of what do I do with the other half of my portfolio? And I'm bullish on uranium. I'm bullish on offshore oil. Then there's other things that I'm like Monster Energy drink. Like it's not going to perform in the next 10 years like it has the last 10 years. But the energy drink market segment is still growing. It's doing well. Things like Celsius are growing crazy and therefore have crazy multiples, which kind of holds me back. So that's tough for me to want to put money into. Then I've been looking into ad tech, advertising technology, the demand side platforms versus the supply side platforms versus the viewability, fraud detection platforms, and looking into all of that. They're tanking. A lot of them are just absolutely tanking. Like Double Verify is tanking, and the other names are slipping. IAS is a ticker symbol. Can't think of it. Many of them are just tanking in price. And maybe I initiate a position. Number one, I don't understand it well enough, and I'm not quite sure yet again if that's the way to play it. And then you have Trade Desk, which is I don't know, like a 40 or 50 times PE. And although I think structurally it'll do well over the long term as a company, I don't know as a stock. Like there's a lot of optimism priced into such things. And so I'm struggling on that. Then home builders and component manufacturers of housing, like LPX, like I own. At one point, I was up 40% and now I'm down 2%. And I'm bullish that, but there's a problem. Structurally, I'm bullish on it. There's a supply deficit, 3 to 5 million houses. The problem with that is home builders have done incredible this year. And that's because the percentage of the market of new homes is higher than its average. That's like 33% of homes being sold are new homes because they're not used homes. And the reason they're not used homes is because everybody's locked in low interest rates when they refinanced in 2020, 2021, early 2022. And, what they call it, the golden handcuffs. So they're not selling, which means that a disproportionate amount of houses being purchased are new houses. So what happens if recession comes, interest rates drop? That's going to be the opportunity that people are going to sell their houses if interest rates do go down. Well, that's not going to be good for the home builders. Not to mention they've ran very hard in the last year. I remember when Builders First Source was $50 a share, I think in June of 2022. Now it's, last I saw, $120 a share. I mean, these stocks have done incredible. And maybe they keep going up. I don't know, but I can't really size that position. So the question yet again is, what do I do with 50% of my portfolio? Say you have a pullback in uranium. I can buy 13% to finish off the theme of Sprout Physical Uranium Trust. Okay, that's now I can have 33% in offshore, 33% in uranium. That's 66%. What do I do with the other 34%? Now, in all honesty, they'll do well. And you want to pay attention to what's doing well in this pullback that we've had in the last week or so. Uranium has held up quite well. Offshore oil has held up quite well. REITs have not. Builders have not. So, what do you do with the rest of the money? Well, you've seen what I've done with my money. I've sent it to money heaven so far. But my names that I'm confident in are such a disproportionate amount in relation to the rest of the book. Actually, you could say it's 50-50 at the moment. Or actually, it's not. It's 50% and 10% cash. But 40% of my portfolio is in losing names. And then 50% of my portfolio is in winning names, but they're winning so much harder than my losing names that I'm still doing well enough. Now, if I continue to, let's call them, make unforced errors, then they won't be able to compensate for my incompetence and ineptness forever. So I plan on building my cash stack to some extent, and if we get a better pullback on offshore or uranium, then I'll be adding to that. I've gone on long enough here today, so I'm going to end it there. Thank you for watching, and until next time.